Hello, folks. Welcome to this week's Forex commentary. And I think if I'm not wrong, this is like the last trading in the month of March. And March has been very, you know, what's the word? I think I'm missing a word, sort of. But regardless, I think we've all had, kind of like beautiful time on the charts this month. There's been lots and lots and lots of learning, and for that, I wouldn't discount anything whatsoever from March's trading. Okay, so now that we are in the last week of trading in March, um, ideally, when we're trading the monthly range, for example, you'd want to expect, especially if the monthly objective has been met, you'd want to expect the markets to return back into the range. Okay, and that's the ideal expectation for the end of the week trading, because if the monthly range has met objective in previous trading weeks, you understand, the later portion of the month, probably the last week of trading, or probably the later days in the last week of trading in that particular month, you would want to see the markets just simply return back into range, because that's how you manage your expectation with respect to the monthly buys. Okay, and it's it's very, very normal, except if probably you are in a month where the monthly range probably met objective, like maybe in the second half of the month, or say the second week of the month, and you know market is going to reject off of heights and from key levels. And when markets return back in the range, maybe when you're trying to um, show confirmation or establish a change in state in delivery to resume bias on probably the daily time frame, and the week ended, you just continue off of that, you know that price action in the next month. But your month where the last trading week is when markets hit objective, or probably the early portion of the last trading week, the market just traded below probably the previous weekly low, and it returns back into the range. The reason why I'm saying this thing isn't for myself, really, is to help people manage expectation on the high time frame, because that's the only way you can find consistency, because a lot of us have trading models already. We already have stuff, we are looking for the charts when we want to take our trading setups. We have all of that. But the issue is, how can we, put them in the right context? Okay, because that's the most difficult thing. Okay, defining context. And for you to define context, you'd have to answer the question of what the draw on liquidity is every single week, literally. And that's why I say, for developing students, the first thing you want to do is, when markets hit objective, you want to wait. Okay, you are not waiting, not because you cannot take trades. It's because you want to see what happens after markets trade into objective. I think I received a comment on YouTube, because I like to answer questions in my videos as well after typing, because I want to show you. Someone asked about liquidity, for example. Say he wants to say a lesson on liquidity, and the truth is, um, liquidity is important, right? But for the basics of defining liquidity, basically, if you go online, for example, on Twitter, a lot of people are having strategies based off of liquidity, and all of that, and it's like our trading system doesn't factor in liquidity. But it's not like, I don't really consider it like they would, because this is what I'm talking about. I focus on previous days high, previous days low, previous session high, previous session lows. Basically, previous highs and lows, previous monthly high, previous monthly low, previous weekly high, previous weekly low, because this is how I form the basis for the draw on liquidity. Now, sometimes the draw on liquidity basically might be an internal range liquidity, for example, like what we're looking at on dollar index, saying the draw on liquidity is the market returning into this weekly gap, but not just the weekly gap, because if it's just this weekly gap, probably this week we have an expectation for the market to make a continuation lower. But look at last week's trade. Ran previous weekly low, closed bullish, right? And what's it saying? Is giving off, the expectation that we can have a bullish week into where? Look at the drawn liquidity here. Now, it doesn't mean a run liquidity doesn't rest above the previous weekly high, but this is the drawn liquidity here. So when markets runs above this high, and since this is the drawn liquidity, institutional order flow predefines what happens when prices engages, this liquidity pools. Meaning, when prices run above previous weekly high, it probably makes a retracement back into the range. All I'm looking for is for markets to re-establish, price action that takes us what? Here. Re-establish price action that would mean bullish at key time of day, at key levels, 4-hour time frame key levels. And I want to engage at key time of day and expect the markets to rebalance this inefficiency. So if you are a developing student and you want to find consistent profitability quickly, although in the ongoing mentorship, we're really going to talk about day trading models. Okay, sometimes when I talk about high time frame setups here and there, folks will think, he probably doesn't know how to day trade. I promise you, if I show you my day trading models, you'd be wowed. But this is the truth. I understand, or I'm even still learning to understand periods when I should day trade and periods when I should focus on the high time frame. For example, take example last week we're talking about Euro USD, saying the markets are going to draw into the weekly fair value gap, which apparently market drew into the fair value gap. But we also have our reference from dollar index, and the expectation is for dollar index to trade into, this level here on the weekly chart. Okay, so since we have that expectation in price, and dollar index is literally the driver, and mind you, market trade into buy side liquidity here. And what do I say when market trades above an old high? You want to wait. But why settle black calling sells immediately markets trading into buy side here? Well, there are some tools that advance, and you're going to learn them because I told you if the draw on liquidity when markets trade into an old high external range, you know what external range is? An old high. It could be a candles range high, it could be an old high like this, or if you look at it from the lens of this high to this low, it's still internal range liquidity here. But when market runs liquidity, you want to expect prices to return back into the range. Why? Because a reaction off of an old high is salient to what? The market absorbing liquidity above this high. Basically, because when market trades into these liquidity pools, you want to see rejection primarily. Now, if this is happening on a weekly time frame and you have a fair value gap here, does it not make sense for the markets to rebalance inefficiencies? Oh, someone says, why didn't they think about that? Well, so you see now, this became the draw on liquidity because market trades into external range. We had, an imbalance, and the expectation would be for the algorithm to rebalance inefficiencies. Can't just keep trading higher, especially for the fact that they ran objective. This is objective. The monthly range is capped. The weekly range is capped. And how do you know what defines the highs, the weekly highs or weekly lows, monthly highs, monthly lows, daily lows? Is this objective? High time from key levels. Running buy side liquidity, old highs is a PD array. Trading into a fair value gap, like dollar did on the monthly time frame, still the same. Now, mind you, this is also a gap on the high time frame. So this is how you want to manage your expectation, and that's the reason why, in as much we have monthly buys, we want to follow it up every single week, managing our expectation with respect to key levels, right? Key levels. If you notice, old highs, old lows, they are part of the PD range metrics. So they are part of key levels also. So when we talk about key levels, we are inherently talking about um, liquidity tools. I mean liquidity. Yeah, that's what we're saying. Because if, for example, we look at Euro USD last week, and we look at this bearish order block, but mind you, when you reference this down candle, this becomes a breaker. This is the order block. This is the breaker. So someone says, "Oh, Settle Black is trying to remake ICT." No, I'm not trying to remake ICT content. It's just you know, it's just it's just it's just basic stuff. So this is a breaker here, but this is bearish order block. Now, if we overlay this key level on the lower time frame chart, this is the key level. This is an old high. Market round above this old high. Someone can say this is liquidity buy side liquidity here, and market is purging buy side liquidity here. And there's a market structure shift on this candle, and there's a setup here to enter this fair value gap. Someone can visualize this price action like this, saying this is liquidity here. But sometimes I wouldn't concern myself with all of the stress of trying to identify liquidity here, especially when I do not, because market is just gyrating at the key level. And we understand liquidity rests above old highs, including each candlestick's high, each candlestick's range, it's high. Liquidity rests above. If you want to talk about it like that, really. So when you focus on key levels sometimes, well, you wouldn't have to worry about this intraday noise. So there are periods when you want to talk about liquidity, and there are just periods when sometimes it's not really about trying to find where the liquidity is resting. Now, on the last module for the YouTube mentorship, we talked about how we can define high time from institutional order flow using the draw on liquidity, basically. And I think we talked a bit about market structure, and that bit of market structure will lead us into the next module of the YouTube mentorship, because now that we understand what the draw on liquidity is, basically near-term price levels that the markets are going to engage, willing or unwillingly. I think that's how I defined it. Okay, and we understand the macro analysis, because we want to do our analysis off of the backbone of what the macro data is saying. But mind you, they overlap. Now, sometimes you might be technically good to just look at the high time frame market structure and determine what high time frame institutional order flow is, because I said back in the day, during my early days of trying to define what institutional order flow is, okay, I simply gave myself to higher time frame market structure. Although I was looking at it wrongly then, I have a way of looking at it now, but it still doesn't discount the fact that if I knew how to look at it well, just by looking at the high time frame market structure, I can still define institutional order flow. I can still define, because this is bullish. This is bullish, for example. All right. So, but I wasn't skilled enough then technically to look at price action like this, to define it. So I would still make lots and lots of mistakes. And that's the reason why, when I do content, I'm making consideration for folks that, at least they understand the basics of the ICT concept or smart money concept. Okay, because ICT concept is the origin of smart money concept, right? So I'm making content for those folks that understand what an order block is, what a fair value gap is, And I really don't say too much about it because, you know, it's the logic, and the logic is in candlesticks. That's where the logic is. Now, this week's um, market commentary isn't basically, it's just straightforward. This is a drawn query. Last week established this bias when markets ran below previous weekly low. Okay. Now, if the drawn query is here and market runs previous weekly low, is that a market structure shift? No, it's a third result. Because what's the drawn query here? And market structure bends to the will of the what? The high time frame drawn query. It run below previous weekly low. When the draw is opposing, it's a third result. So you want to frame a buy setup based off of the idea that this is a false run below an old low because the expectations for the markets to return here. So when markets run below old low, you want to discount it. You don't see it as validation for more sell side. You want to see it as a false run below an old low for markets to return back here. I think the third module for the YouTube mentorship is basically going to be about, you know, market structure and validating the high time frame institutional order flow. And we're going to look at it from the lenses of the drawn liquidity. I mean, even when market is opposing the long-term bias, and we're going to look at it from, you know, the aging program, you know, the raw data, for example. So the expectations for markets to return here. Now on the daily time frame, dollar index, we kind of like said a lot of things in the last commentary on dollar index, and if you revisit the commentary, because the commentary would just be like my public journal, really, because personally I revisit them during the week, especially when candles start trading, because I can lose sight of what my expectation was at the start of the week. You understand? And it's the markets are crazy, so you just need something to stay sane. So last week we referenced this down candle, Tuesday's 11th of March candle, and we said, market has been gyrating at this resistance here, so it wasn't looking bearish. Sorry, it wasn't looking bullish because of this rejection, and I was talking about the fact that a closing basis below this consecutive down candle sends prices into the previous weekly low, basically. So when Monday closed below this low, Tuesday was likely to run here, but the early portion of Tuesday was giving off bullish, and market already ran the query here, so it now became subjective again if they were going to run previous weekly low or not. Okay, and if you study this price action during the overnight session during Asia, the markets were running higher. Apparently, because of the markets were in consolidation, so they traded back into the range, not leaving any space for any inefficiency. Basically, a balanced price range. Sorry, efficient price range, not balanced price range. Efficient price range. So there was like an efficient delivering price. Look at here, a volume balance here, sell side offered here, and the markets traded into this volume balance to deliver buy side. Okay, there's a volume balance here. Market delivers sell side inside this volume balance, and the markets return again to deliver buy side. Even if there's been back and forth, but it's algorithmic, and the markets will always want to deliver prices efficiently. So market turned into sell side previous weekly low, which is very fine, and established the weekly bias with a green candle close on Wednesday. Now this candle closure isn't ideal, because ideal candle closure for someone to define Thursday as high probability is to see this candle not just close bullish, but close and trade above this volume imbalance. This would be the basics if you're validating the high time from institutional order flow. What's the high time from institutional order flow? Well, the drawn liquidity was the weekly gap. So if you want to validate it well, just a green candle, validate it. But you can see this rejection here. Okay, and you can see this volume balance, the markets are staying below. So you see that an ideal scenario would be for markets to what? Close above this volume balance, and see the next day just return back here and rally. That would be ideal scenario. But ideal scenarios is periods when we're just learning about institutional order flow, market, and all of these things. So the kind of tools that are usually in place are tools to guide you, okay, at the start. Okay, when you just start learning stuffs like this, these tools will just help you, wait for this, wait for that. But it doesn't mean you can engage if those things aren't to the T. Alright? But time and experience, only time and experience would, um, give you the understanding of when to still expect, markets to continue like this and when not to. Because now we have a context. And what's the context? The context is the weekly gap. So a green candle already validated, and the next day market trade through, and Friday was bullish. Now someone might say, oh, I'm not sure Friday is going to be bullish because we didn't trade above this Tuesday's candle, and we've not validated a change in state in delivery on the daily time frame. Markets are still below these down candles. Oh, trust the high time frame draw on the query, okay? Because like I said, it's going to bend the wheel of market structure, because this is a high resistance liquidity kind of scenario, because markets are hitting objective. Market ran below above this high on Thursday, so you'd have to see it in the rejection basically. But then we understand that our ideal expectations for markets to trade into this volume imbalance. So the high time from institutional order flow or the drawn liquidity predefines what happens after market engages this high. And what happens? Well, markets will still have to resume buy side to continue into this range. That's simply what's going to happen. So for today's trading, basically, Friday already gave off, that Monday is likely to be bullish because Friday was bullish. A green candle closure above this candle's high. So Friday bullish, so Monday likely to be bullish. And even if we want to engage in Monday's trading, not in London session. No, not in London session. Let London session do whatever you want to do. Alright? So let's see the 4 hour time frame and let's see if there's something we can use. Alright. So on the 4 hour chart, we have sell side here. Markets run sell side against the high time frame drawn liquidity, which is in buy side. So this is a Tory soup, and markets has been bullish since. And I think we're going to talk a little bit about Tory soups because it's kind of like a 3-stage event. First, an offset accumulation. Second, a reaccumulation to discount. And third, the market seeks near-term imbalance. Now, this 3-stage event is how I defined a trading model in short-term trading. You can visit my YouTube channel in the playlist session. You'd see trading the weekly range, short-term trading, the supplementary lesson. I talked about a short-term trading price action model, okay? And I think it's a very beautiful lesson you would want to see. You just understand the kind of things I'm saying right now here. So that's it. This is a 4 bullish order block. Mind you, markets trade below an old low. Here, markets traded below an old low here. And markets trading below an old low yet again, when we understand that even if markets trade into the weekly gap, the drawn liquidity remains the weekly volume imbalance. So you can see a run below a short-term low when market hasn't engaged our idealized drawn liquidity is a Tory soup. This is a false run below an old low. And now when market runs liquidity here, there's a 4 hour bullish order block. Market close above this candle, a change in state in delivery, and market return back into this order block. That's bullish. That's bullish because this auto block here is high probability. It validates a change in state in delivery and was associated with what? A run on liquidity here. So this auto block is high probability and the market is continuing from here. Well, Asian session is trading higher. Well, I expected it because Friday already validated more of the weekly buys and market trade into the key level during the Asian session. Well, Asian session is maybe key time of the buy. I don't have any study primarily during the Asian session, right? Just the London session. So if markets is gone higher, well, doesn't mean we've entirely missed our entries. Well, nope. If you study this down candle here, you want to see the markets trade and close above this down candle, okay? And you are eyeballing this fair value gap here. This is how you frame your intraday draw on liquidity with respect to the weekly buys, with respect to the weekly draw on liquidity. Okay, so you have it here. Take this one off, take it off, and you want to see the 4-hour time frame change its state in delivery. What do I mean by that? Well, you can see the market has some downward push. As soon as this candle closes above, it validates that the 4-hour time frame is now in alignment, okay, with price delivering higher with respect to the weekly buys. That's a change in state in delivery from bearish to bullish. And when market trades are both here, a retest of this down candle at key time of day would give you the prognostication that markets are willing to engage here. This is about a 37 pip range. It's not too much, but it's something. Imagine waiting for everything to align and you engage. You're proud of yourself. So this is about 37 points on dollar index, and this would be my expectation on the 4-hour time frame. So Euro USD basically will just mirror dollar index when we are running stuff with Euro USD. We still have this sell side objective here for the markets to engage, and when markets engages sell side, then we're going to see what happens there. Right now, this is the draw on liquidity here on the 4-hour time frame. This is it here, and we'll just wait for the markets to engage sell side, and we're going to wait. This is the end of the month, and a new monthly candle, and we'll determine what happens then. I hope you found this one insightful. Until I see you next one, be safe. Oh damn, for those that managed to get to the end of the commentary, I sincerely appreciate. Kindly share, like, subscribe, do all of the beautiful stuff. Ask questions and comments. I'm more than willing to respond, and just support the channel. Really support the channel. Let my content get to more people, and I just want to see more people watching my content. It's fun. It's really fun. I'll catch you in the next one.